If Denny and I had to start over from scratch in real estate investing today, no properties, no experience, no network, but knowing everything that you and I know today, Denny, how would you go about real estate investing differently?
Well, Brian, there are four things that I definitely would do differently, and we're going to discuss them here. So, everyone, welcome to Bucks Outside the Box. This is where we discuss and challenge conventional thinking and investing differently and sometimes better. Well, all the
There you
time
go.
better.
Get a little contrarian in here. So before we jump in, it's worth noting 2026 is not like every other year that we've ever seen in real estate. It's a pretty interesting window for investing. There's a lot going on, good and bad for investors. So you've got interest rates that are sticking around, higher interest rates that are, hovering higher for longer, especially with the Iran war that we've seen recently that drove up interest rates in a big, fast spike. You've got a lot of newer investors who are sitting on the sidelines, wondering whether they should get in or not. There's been a lot of losses in real estate over the last 4 years because of the very fast jump in interest rates in 2022. That messed up a lot of real estate
Not
investors.
to mention the prices of the homes themselves, which went crazy, which adds to the high interest rates.
Yeah, absolutely. So there's this growing gap between people who want to invest, people who are actually pulling the trigger, and a lot of people who are scared by what they've seen over the last couple of years. But prices for real estate, commercial real estate anyway, multifamily and industrial and mobile home parks and et cetera, have crashed downward over the last 2 years, which was terrible for people who had invested, say, 5 years ago. It's not such a bad thing for people who are investing today, right? Who are the beneficiaries of those much lower prices. They're getting in at a much lower price point. But there's this interesting dynamic where people are still, a lot of investors are still scared on the sidelines because of what they've seen over the last 4 years. But that's actually makes it a better time to invest when, as the expression goes, when there's blood in the streets, right? And there is, plenty of distress in the market right now, which is terrible for sellers. It's great for buyers. So with that being said, let's talk through some of the opportunity today in 2026 and how to approach that, as a brand new investor, because you and I have obviously been in real estate investing for many decades, but we're putting ourselves in the shoes of someone who has never invested before and what we would do differently if we were in their shoes.
Right.
So step one, first point here, Denny, why don't you get us kicked off here with the first thing that you would do differently if you were just getting started in real estate investing today?
Well, I think that I would definitely start with more passive investing than active. And I grew up learning that active was the way, but I didn't realize the burnout and some of the costs and everything else that comes with that. So I definitely would start with passive.
Yeah, and a lot of people, they'll go in bigger pockets and they'll read articles about buying rental properties or flipping houses. And, it sounds very passive, right? There's nothing passive about it. Buying properties yourself directly is a side hustle or a full-time
And
business.
Brian, when I was growing up, it was talked about. That's what it was called, passive investing.
Yeah, but there's nothing passive about it. I mean, you and I have both been there. We have owned rental properties. Between the two of us, we've owned dozens of properties, managed hundreds of properties in your case. And it's a lot of work. Landlording is a ton of work, finding properties to buy, doing the due diligence on them, getting them funded, getting them renovated, dealing with city inspectors, dealing with tenants and property managers. It's a massive lift. It's a lot of work. It is a full side hustle if you're buying one or two or three a year. If you're buying 4, 5, 6 plus a year, it's a full-time job. It's a full-time business, basically. And there's nothing wrong with it as a business model, either side hustle business or a main business. There's nothing wrong with it, but it's a business, right? And that's a different conversation than passive investing, like, say, investing in an index fund that mirrors the S&P 500. That's completely passive. Going out and buying and renovating properties and putting tenants in them and managing them and dealing with inspectors and contractors and tenants and managers, that's not passive. That's a business. So they're just two different things. It's not that it's a bad business model, but it is a business model. So that is worth understanding here. And there's a couple types of liability that come with rental properties, active investing, direct ownership, that don't come with passive investing. And so one of those is legal liability. You can be sued. I have been sued. You've probably been sued.
I've been
As,
through a lawsuit for sure.
yeah, as a landlord. So you have legal liability that you don't have as a passive investor. You also have debt liability. So you sign personally on the dotted line for rental property mortgages, hard money loans, any almost every type of financing that you can get for an investment property. You're signing a personal guarantee. So if you default on that loan, if something goes haywire and the worst happens, you default, they're coming after not just the property, but your personal assets. That is also not the case with passive investments. And it's worth pausing here to define passive investments for people who are
Yes.
not familiar with them. So syndications are one common type. Yes, the one that a lot of people know about. That's not the only option. You can have private partnerships, joint venture partnerships or JV partnerships with active investors where you're coming in as a silent partner, basically, and you're providing some of the funding. You're not doing any of the actual work on that. And in many cases, you're not on the hook for any of that legal liability or debt liability. Funds, whether those are real estate equity funds or secured debt funds, are another option for passive investing. Private notes that are secured by real property, another type of passive investing. So you have a lot of options here for passive investing that don't come with all of the labor, all of the skill required. Not that there's no skill required with passive investing. There is some involved in, learning how to analyze deals, but it's way less. You can learn the fundamentals in an afternoon for passive investing. It takes months or years to learn the fundamentals of active real estate investing. So
how does one plug into or learn about passive investing?
Well, I appreciate you teeing that up for me, Denny. So, for one thing, we have a free course on passive investing going through some of those different options that we just talked about a minute ago, but going into them in more detail and giving real life examples of passive investments that you and I have made in our co-investing club, which it brings us to actually the second thing that we would do differently, or at least I would do differently. I would plug into an existing community of investors, of passive real estate investors, people who are getting together every month and vetting investments together as a community so that you're benefiting from all of the collective knowledge of all the other people in that investment. So you all get together and analyze the risk of an investment together as an investment club. You can all, so this is what we do, by the way. Denny and I organize the co-investing club where we meet once or twice a month. We bring the operator in, the real estate operator in, and then we all grill them with questions together as an investment club. And then we kick them off the call and we have an internal club discussion about what are the risks that we see in this deal? What do we like about this deal? What are our concerns about this deal? What's the timeline? And what are some of the things we might not be thinking about with this deal? What are some of those externalities? So we vet them together as a club, and then we go in on them together as a club too, so that each person can go in with much smaller amounts than you would need if you're investing by yourself. So with passive investments,
what would the typical amount be if you're investing by yourself?
Yeah, and that's an important thing for novice investors to understand. Whether you're going the active investing route or the passive investing route, you're looking at typically $50,000 to $100,000 if you're investing by yourself. As an active investor, that's down payment, that's closing costs, that's initial repair costs, maybe cash reserves. Not that that's a cost, but it's still cash you need to have handy. For passive investments, normally the minimum investment for them that is allowed by the operator is $50,000 to $100,000. So not a trivial amount of money, right? And that makes it really hard to diversify if every time you're plopping down money into a new investment, you're putting in 50 to 100 grand. When you go in on these with other investors, you can invest with much smaller amounts because you're splitting that investment among a bunch of investors, right? So in our co-investing club, for example, $2,500 is the minimum investment if you want to participate in a deal. That's for our VIP membership level. Our investor membership level, the minimum investment is $5,000. So either way, a tiny fraction of what you would need if you were investing by yourself in these investments. And that makes it much easier to diversify and spread smaller amounts across much more investments, many more investments, so that your returns averaged over time, they just start to form a bell curve, right? Some of them are going to underperform, some of them are going to overperform. Most will be in kind of the middle of the bell curve. And that's a much lower stress way to invest than parking on
Also decreases stress over large amounts that could,
Exactly. All right. So that's number two. The second thing we would do differently if we were getting started today. And by the way, when I started investing in real estate 20 plus years ago, I went out on a buying spree for rental properties. And I didn't know what I was doing. I didn't develop those skills that I needed. And I made a lot of mistakes. And they cost me hundreds of thousands of dollars later on. Truly. I ended up having to start over from scratch later in my 30s, sold off all the rotten apples, and that wiped out a lot of my good investments too. Just giving some context that I did go through this. I did start investing actively, and then I did actually have to start over from scratch at a certain point in my life, many years later. All right. Then the third thing that we would do differently today is offset taxes and approach this from a much more tax-oriented way. And it doesn't mean that taxes are the main reason to invest in anything, real estate included. But if you are thoughtful and intentional about your taxes, you can reduce your tax bill with passive real estate investments. You get a big upfront deduction in the first year when you invest in some passive real estate investments, not all.
Right.
So syndications are the big one that come with a big tax write-off. Sometimes partnerships, sometimes private partnerships as well. But syndications are the big one. You get a big depreciation write-off in year one for most syndications, or a lot of syndications rather. And you can use that initial tax deduction from that first year from a new investment to balance out or negate your tax bill from older passive real estate investments that have gone full cycle in that same year, paid out the profits. The property sells, you get your profits back from the sale, you have to pay depreciation recapture. So you end up with a big tax bill from that. You can use the new investment, the write-off from the new investment to offset the tax bill from the older investment. And there's a name for this strategy. Denny, what's it called?
The lazy 1031 exchange.
Yeah, and it's much simpler and easier than a real 1031 exchange, which requires you to hire a qualified intermediary, and you have to identify the new replacement investment within a certain number of days, and you have to actually settle on it within another window of days. And you got some really tight times there.
Paperwork.
Yeah, it's very onerous, and it's expensive. Paying a qualified intermediary to hold all the money for you, super expensive. With a lazy 1031 exchange, you don't have to actually do anything other than invest in a new investment in the same calendar year, as the outgoing one, as the one that sells, right? And then you automatically get the benefit. You get the tax write-off from the new one, offsets the tax bill from the old one. Or, if you don't have any of those older investments that have gone full cycle that year, or paid out your profits that year, you can use it to offset other types of passive income or investment income, right? Capital gains, maybe from selling stocks, dividend taxes, taxes on dividend income from your stocks, for example. You can use the tax write-off from a new syndication to offset those other investment taxes as well. That's the
Check
third
with your
thing.
accountant, though.
Yeah, no, of course, always check with a paid professional. All right, the fourth and final thing that I would do differently today, and everything that we've talked about so far kind of comes to this, and that is practicing dollar cost averaging with my real estate investments, which is really hard to do if you're putting 50 or 100 grand per investment. Like, no one's able to invest every month or every quarter in a new $100,000 investment unless they're crazy rich, right? Whereas if you're investing 2,500 at a time, $5,000 at a time, you can actually practice dollar cost averaging, investing every month, maybe every quarter, depending on what you have available to invest. But that's realistic for a middle-class person. Whereas investing 50 grand every month, 100 grand every month, or even every quarter, that's not realistic for a middle-class person. They can't practice dollar cost averaging, investing slowly and steadily month in and month out. You just can't do it at those numbers, right? 50 grand, 100 grand. It's too much money. So you can't practice that dollar cost averaging to just keep investing slowly and steadily rather than trying to time the market, which you inevitably end up doing if you're only investing, once a year, twice a year, once every other year, because you have to invest so much money in every single investment. Then you're tempted to try to time the market because you're only making a rare occasional investment. Whereas you invest every month, every quarter, you remove that temptation. You're just investing slowly and steadily. The market's going to go up and down, and you will be the beneficiary over the long term. Property values rising, paying down your debt over time with real estate investments, collecting that cash flow from real estate month in, month out, quarter in, quarter out. So that's the fourth and final thing that I would do differently. So let's talk about the reason most people never benefit from these, the tax benefits we're talking about, the cash flow, the appreciation. And that's that they never actually get started, right? They don't actually take action. They sit on the sidelines in analysis paralysis. And, these are smart people, six-figure earning professionals they're smart, they're educated, but it's so easy to get stuck in that loop of analysis paralysis where you're just, reading articles on Bigger Pockets or listening to podcasts about real estate investing and never actually investing money and taking action. Yeah, they get overwhelmed. They get really worried about making mistakes. And, there is something to that. You don't want to just dive in headfirst in buying rental properties like I did, because that is a recipe for losing a lot of money. So that's what we're trying to help you avoid with this video and this podcast is, how to actually get started from scratch, even if you've never invested in real estate before. But, getting started is the key point there. So toward that end, we mentioned it a few minutes ago. We do have a free video course. It's a great starting point. It's 8 videos long. They're all really short and sweet. They're like 5-10 minute videos, very punchy. And there's some trivia with 90s movies in there. It's always good fun. But yeah, we walk through 5 different types of passive real estate investments, some of the pros and cons of each, and real life case studies of ones that we've actually invested in the Co-Investing Club. So check that out, sparkrental.com/free for that course. You will come out of it a smarter and savvier investor. We guarantee it. Regardless of whether you end up joining our community of investors, whether you want to go it alone later, that's all fine stuff. So if you got a fresh perspective from this episode, subscribe to the show. We are putting these out every week and hopefully bringing a lot of value and helping you become a savvier investor over time. And if you didn't get any value out of this show, then email us and let us know what you want to see instead. Support@sparkrental.com.
Be nice.
And of course, constructive criticism. But yeah, and of course, consider joining us in the Co-Investing Club. There is a free option there for you to just come and check out, sit in on our deal discussions, see what kind of investments we're looking at as a club, how we vet them together as a club, how it works. So check that out as well at sparkrental.com. Denny, anything you want to add before we call this episode complete?
Just one thing. The value of just discussing, maybe not even investing with, but the value of discussing these kind of deals with a big community is priceless. It really is, because you get to hear so many different opinions and sides of things, and it's just amazing.
Yeah, no question. There you get the hive mind, if you will. You get the benefit of every other investor's experience who's in that room. On that note, stay weird, unconventional investor, and we'll see you soon.